Let's have a look at preference shares. What is a preference share? Now, we said that a preference share is a financial instrument that has debt, fixed dividends, and equity capital appreciation characteristics. So every preference share is associated with a certain dividend rate, and then the company has to pay that minimum percentage dividends based on that rate and the capital amount which was invested by the investor on an annual basis to the preference shareholder if the dividend was declared. Now, the preference shareholders also have a higher claim on assets or repayment of capital when this company ceases to exist. They are sharing in whatever is left in the company before the ordinary shareholders can share in whatever is left. And obviously then in earnings and dividends, they are entitled on a dividend based on the percentage or the rate of the dividend that is applicable on the capital that was invested by the preference shareholder before an ordinary shareholder can share in the profits of the company by ways of an ordinary dividend. Also, because there's a fixed rate dividend attached to the share, they know exactly what is the minimum dividend that they're going to earn from this company on an annual basis. Have a look at this YouTube video, which explains to you very good and very, very concise terms what a preference share is all about. Now, what is the benefits of investing in preference shares? Well, you know that your capital is going to be repaid before the ordinary shareholder is going to receive any repayment of capital when the company ceases to exist. Now, because they are fairly highly risk type of investments, they also earn a higher level of return. So the income that they can earn on a preference share is more than what the income is that they can earn on just granting a loan, for instance, to somebody, because there's more risk involved. And then always, although they have a fixed dividend percentage attached to the preference share, they are only entitled on that dividend if that dividend was declared by the company. But then, if a dividend is declared, we also know that the preference dividends must be declared before any ordinary dividends can be declared. So therefore, they stand in line for dividend declaration for share in the profits of the entity before the shareholders. The negative of this is they are only going to get this fixed rate that is attached to the shares that they have, where there is no limitation on the dividends that the ordinary shareholder can earn on the shares that they have invested in the company. Right, what type of preference shares do we get? The first one and the most common one is a cumulative preference share. Now that means that that dividend is accumulated even if the company does not have enough profit to declare a dividend. So let's say 2016 the company could not declare a dividend. 2017 they could not declare a dividend. 2018 and 2019 they couldn't declare a dividend, but in 2020 eventually they are now able to claim or to declare a dividend. Now if it's a cumulative share, they will have to, before they can pay out 2020's preference dividend, they first have to pay out 2016, 2017, 2018, 2019 and then only 2020. So they have to make good for the past before they can actually declare the current financial year's dividends. A non-cumulative dividend is not like that. If they couldn't have declared dividends, there's a fixed dividend rate attached to the share, yes, but the same thing applies. They couldn't pay dividends in 2016, 17, 18 and 19 and only in 2020 they declare a dividend. Then they can declare the 2020 dividend without making good for 2016, 17, 18 and 19. So then they forget about the past and they only focus on dividend declaration for the current financial year. Very important there in red, preference shares are cumulative unless expressly stated otherwise. So remember that. What is a participating preference share? Now it says, well, there is a fixed dividend rate attached to the preference share. It says, but over and above that fixed dividend that this guy is entitled on, if the dividend is declared, he can also share with the ordinary shareholder in in a profits that's remaining after the fixed dividend has been paid. So there's going to be some profits that is available for distribution to the ordinary shareholders, but this participating preference shareholder shares with the ordinary shareholder in that dividend then as well. So let's say that the profit for the year available was, after tax, was 100 Rand. First 10 Rand belongs to the preference shareholders based on the fixed percentage dividend rate attached to the share. So how much is now left for distribution? 90 Rand. And then a participating preference shareholder now shares in that 90 Rand with the ordinary shareholders. So over and above their fixed percentage dividend, which they are entitled on, they are also entitled on sharing with whatever the remaining distributable reserves or profits of the company is with the ordinary shareholder in whatever the dividends is that's going to be declared. A convertible preference share says that somewhere in the future, the company can decide to convert this share, preference share, into an ordinary share. So that is first prize because the ordinary shareholder, there's no roof on the number or the amount of dividends that they can declare and that they can receive. And all this ping, 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 that's everybody that couldn't load their Fundi tests. And so the convertible share then is going to be converted into an ordinary share somewhere in the future. What is the benefits for the shareholder but for a convertible preference share? Well, now he becomes a real shareholder. If he's an ordinary shareholder, he has the right to vote on the general meetings. And what do they do in the general shareholders meetings? They appoint a board of directors. They approve very important strategy and strategy changes that the company makes. They also decide what is going to be the dividends that is going to be declared to the ordinary shareholders. So it's much more, and the capital growth on the investment is much higher on an ordinary share than what it is on a preference share. So that is very beneficial to be converted into ordinary shares somewhere in the past. And then we get the redeemable one. Redeemable means, and we've already spoken about that this share needs to be repaid to the shareholder at some future date. So the shareholder has invested X amount at a fixed rate into the company, and that amount needs to be repaid to the shareholder somewhere in the future. And we said that a compulsory, redeemable, cumulative preference share is exactly the same as loan finance. Why? There's a fixed dividend rate which equals a fixed interest rate. There is a certain date on which this share capital must be repaid to the shareholder, which is the same as loan capital that needs to be repaid to the person or the body who has actually provided the loan finance to the company at a certain date somewhere in the future. So therefore, a compulsory redeemable cumulative preference share is treated in the statement of financial position not as part of equity, but as part of non-current liabilities. It's exactly the same as a loan. And then that fixed dividend attached to this redeemable preference share, that is treated in the statement of profit and loss as an interest, a financing cost, opposed to a dividend, which is equity. And we've said that the dividend is not an expense, so a dividend does not appear in the income statement. It only appears in the statement of changes in equity, where it reduces my retained earnings. So a compulsory redeemable preference share, that dividend attached to that share is treated as finance cost in the statement of profit or loss, and then the outstanding loan amount, the outstanding capital amount, is treated as a non-current liability in the statement of financial position. Okay. Who should invest in preference shares? An investor who looks for hybrid debt and equity investment exposure. So it is slightly more risk than just plain loan capital, debt instrument. And for that, it is also then presenting a little bit of a higher return just than investing in a normal debt instrument. Right. What is the difference between preference shares and ordinary shares? The preference share have a preferential right in terms of the entitlement to receipt of dividends as well as repayment of capital in the event of the company cease to exist. So what that means in plain simple English is that he is entitled on a certain percentage dividend on an annual basis if it's a cumulative share. It doesn't matter whether it's a cumulative or non-cumulative preference share. When a dividend is declared, the preference shareholder must receive the dividend first, and then we will determine how much money is left after he has received this dividend for the ordinary shareholder to share in an ordinary dividend. They know exactly how much dividends they're entitled on because there's a fixed dividend percentage attached to the preference share. So he knows how much he is entitled on, and that needs to be paid to him before the ordinary shareholder can receive any dividends. The ordinary shareholder can receive anything. Now, if there's not a lot of profits, obviously maybe the ordinary shareholder is going to receive less dividends than the preference shareholders. But if the company performs well, then obviously the ordinary shareholder is going to receive more dividends than the preference shareholder. A preference share have no voting rights, and in the event of non-payment of dividends, they may have a cumulative dividend feature, and that requires that all dividends has to be paid out before any ordinary dividends are allowed to be declared or paid to the ordinary shareholders. However, the ordinary shareholders have a voting right. They can vote on the annual general meetings. They appoint the board of directors and they approve important strategy changes that the company wants to undertake. Let's quickly do an example. Let's say a company issued 20,000, 12% cumulative compulsory redeemable preference shares to the value of 40,000 Rand. The directors do not declare dividend in the 26th financial year. On 31 December 27, the directors declared an ordinary dividend amounting to 30,000. Now, if they declared an ordinary dividend there, I don't have to tell you that, but they first had to make good the dividend of 26, preference dividend, because it's a cumulative preference share, as well as the 27 cumulative preference dividend. Before an ordinary dividend could have been declared. The profit after tax was 125,000. So although there was no dividend declared in 31 December 26, because it is a compulsory cumulative preference share, I had to make provision for that interest on that share. Remember, because it's a redeemable preference share, we treat it as loan capital and not as equity. Therefore, that dividend, that 12% dividend on the 40,000 Rand, which is 4,800 Rand, is going to be recognized as an interest expense in the income statement. So we will debit interest expense, 4,800, and we will credit our preference shareholders with 4,800 for 26. The company owes that 4,800 to the preference shareholders, although they're not going to pay it because there was no dividend declared for 26. In 27, though, a dividend was declared because there was an ordinary dividend declared, so by implication, the dividend here was declared. So again, it's interest because this dividend is of an interest nature, so we're going to debit our interest expense once more and credit our liability account preference shareholders 4,800 Rand. So at the end of 27, the company owes the preference shareholders 9,600 Rand. So eventually, when this dividend is going to be paid, then we're going to debit the preference shareholders and we're going to credit bank with 9,600 Rand. At the end of 27, though, we are also declared an ordinary dividend, so there we're going to debit dividends now, 30,000, and credit shareholders for dividends, ordinary dividends of 30,000. Then we're going to debit retained earnings with 30,000 and we're going to credit dividends with 30,000. So that 30,000, the ordinary dividend, is going to reduce our retained earnings as at the end of 27.